Hi everyone, welcome back to the channel. The market has undergone drawdown, especially within the tech sector. This has drawn my interest towards big tech names like Google, Microsoft, and Amazon. I have spent lots of time studying these companies and still can't decide which to buy. So let's look at the QQQ ETF that allows one to own them all. The bottom line of the video is that QQQ gives you exposure to the FANG names and that tech has corrected near to 30% and is not insanely expensive in terms of valuation like the dot-com crash. Do note that this video is for educational purpose only. Do not treat this as an investment or any form of advice. Always do your own due diligence as the information may be incorrect or outdated and I may be biased in my personal views. I will share my personal thought process here, which may be different in your circumstances. Personally, I have deep conviction in the tech sector. I have seen how tech has changed and brought much value to our daily lives, which means the companies enabling these services will similarly grow in terms of company value. But before one invests in anything, he or she should do comprehensive research to build conviction, which requires lots of effort and time. I was thinking, what's the alternative if one wants to skip the aforementioned hassle? The answer will be via a tech ETF. I have separated the tech into two distinct buckets as they are on a different company life cycles and therefore vary by risk and return profile. On the left, we are talking about allocating to established leaders via QQQ ETF. Most of these names are already generating high operating profits and cash flows with strong balance sheet. Some are even giving out dividends and increasing share buybacks to reward shareholders. These traits suggest that these companies are in the scaling to mature growth stage. On the right, we have out-invest with disruptive companies that may be potential multi-baggers if they could displace the current leaders one day. While the upside is tremendous, it comes with uncertainties if the management can execute the growth strategy, is there a product fit, and whether the company fundamentals can withstand the test of time. For example, most are at operating loss with high cash burn, and this is not ideal given that interest rate is high and it's hard to borrow money. Also, share prices have tanked and not conducive for issuing of more shares. While knowing these challenges, I personally pick stocks and invest directly into this space. For example, I share about C Limited and Blender in my channel. Please feel free to check them out. I have said so much as the distinction between the two groups are so crucial in terms of risk and reward. For the purpose of this video, I will zoom in on QQQ for these reasons. 1. I want to have exposure to big tech names beyond my current investments into disruptive potential future leaders. The ETF reviews the companies periodically and will kick out names that do not make the mark every year, so it's a passive investment which does not require as much work on my end. Lastly, it has been able to give about 20% returns a year in the past. While past returns do not represent the future, it's worth a thought if one can't even generate the same amount of return, then investing into ETF may not be a bad idea. It's important to know what's the underlying companies in the QQQ ETF. It mirrors the Nasdaq 100 index, which means the top 100 non-financial companies listed on Nasdaq by market cap. It may include ATRs such as Pinduoduo, Baidu, and JD.com. The list of companies will be reviewed annually, which means some companies will be kicked out while some are added in. The index will be rebalanced every quarter. Moving down to fund details, these are the information on the ETF itself. It has been around since 1999 with an expense ratio of 0.2% and there are 102 stocks in the ETF. You have to know that the ETF is heavily weighted towards these top 10 names that contributed slightly above 50% by allocation. This means the price movement and returns of these top 10 names heavily influence the ETF returns. You should seriously consider if these companies are attractive investments to you. While this chart seems like there are only half tech names, I would see the ETF as almost all tech. This is because consumer discretionary are heavily weighted toward Amazon and Tesla that makes up 10% of the ETF, while communication includes Alphabet and Meta that accounts for 11%. I see these four companies as IT, and that sums up to 70% into infotech in the whole scheme of things. The return profile of QQQ has been outperforming S&P as you can see in table 1 and 2. If you focus on table 2, that's an annual returns of near to 20%, be it 3-year, 5-year or 10-year view. I think this is great returns that are near to Warren Buffett level purely by investing into an ETF. Table 3 shows you that the ETF returns are positive for most years and have been strong from 2019 to 2021. These great returns reflect the economic value that have been created as tech has generated lots of benefits in our daily lives. But some may argue that we have been on a low interest rate environment and Fed policies have been accommodative in driving up share prices. My point here is this: past performance do not reflect the future. Therefore, fundamentals of the companies in the ETF are highly likely to be reflected in long-term returns. You have to exercise your own judgment, look forward and not rely purely on history. I do hear people mentioning that this is another dot-com bubble potentially. I do not agree with the view from the data below. Looking at table 1, you can see that around 90s to 2000, prices have far outgrown earnings and P ratio compared to and P ratios have came to insanely high at the 70 to 80. That's not the case for the past few years now, when the red and black line have gone up together, which kept the P ratio at around 20 to 30 level. Please note that this chart is outdated as it shows up to 2016 to 2017 timeframe. To overcome this, I added table 2 to show you that the P ratio is currently at 25, which came down significantly by 29% from a year ago of about 36. Today, big tech firms are market leaders who are generating high profits and cash flow. They are not the early stage of finding product fit or trying to scale like during the dot-com bubble days. But macro is still weighing heavily on stock price with supply chain issues and inflation dominating the headlines. As a long-term investor, one should be more objective than sentiment driven. It's notable that QQQ has hit the 150 moving average level that rebounded off back in 2019 and during 2020 COVID crash as well. This is after a 30% correction, which is again similar to COVID period. Do note there's a possibility that it can still go down to 2200 MA or even lower. I am more fundamental driven, so do not put much emphasis on this slide. I'll put it here as additional data points for your reference if you are keen. The takeaways are here. QQQ ETF provides you passive exposure to big tech firms like Amazon, Google, and Tesla. These companies have generated lots of value with their services, with market rewarding them with strong past returns. Do note the ETF is tech heavy and concentrated on the top 10 companies, so this is not a diversified ETF like an S&P 500. In terms of valuation, P ratio of 20s is not as high as during dot-com days, as the companies are generating solid profits and cash flow today. I still find it hard to comprehend that Coca-Cola is already trading at a higher PE than Google, despite the difference in growth rates and margin profile. But valuation might continue to drop as share price has declined about 30% and down to 150 MA due to the current macro environment, and that may continue to weigh down unfavorable to tech companies. That means more homework has to be done in such uncertainty backdrop. I have now come to the end. Please let me know in the comments if there are companies you want me to drill into. I would really appreciate if you can like the video and subscribe to the channel. Thanks for tuning in.